of Business, Center for Innovation. I want to welcome everyone. I'm Sylvia Burwell, and I am proud to be the president of American University. And as the first woman president, I'm especially pleased to be able to introduce and welcome today's speaker, who is our first woman Treasury Secretary. And here at AU, we are home of the Eagles, and I would like to say that our speaker has quite a wingspan. Her career is nothing short of remarkable. She started in the Academy, and we welcome her back to the Academy, and she is the first person in American history to be the leader of the White House Council of Economic Advisors, to lead the Federal Reserve of the United States, and to be the Secretary of the United States Treasury. And I had the great privilege to work with Secretary Yellen when we both served in the Clinton administration, and during that time she was the chair of the Council of Economic Advisors. And here at AU, we pride ourselves on being change-making, and wherever and whatever Janet Yellen does, that is what she does. She listens, she uses her breadth of experience and knowledge, and she makes things happen. And I was so pleased when she was named to be the Treasury Secretary, because I knew that the nation's finances and economics would be in great and incredibly thoughtful hands. And so I'm so pleased to have the opportunity to hear her here today. And she truly is a change maker in this changing world, and we're honored to have her here at American University. And with that, it is my great pleasure to introduce the 78th Secretary of the United States Treasury, Janet Yellen.
Thank you. And thank you so much, President Burwell, for that kind introduction. It's really great to be with you again. And I'm really happy to be at American University, where change makers are changing the world. Groundbreaking leaders in government, academia, and business have walked these halls. And I'm pleased to be here to discuss the Biden administration's approach to digital assets. A few weeks ago, President Biden signed an executive order calling for a coordinated and comprehensive government approach to digital asset policy. Digital assets have grown explosively, reaching a market cap of $3 trillion last November from $14 billion just 5 years prior. Digital assets may be relatively new, but they're part of a larger trend, the digitization of finance, that's been in the making for decades. In 1990, there were fewer than 3 million internet users. And now there are about 4.5 billion. And we take for granted that many aspects of our financial lives can be managed from small internet-connected devices that fit into the palms of our hands. This growth in digital services has opened up a world of possibilities and risks that would have seemed fantastical only a few decades ago. Financial services, along with most industries, have evolved in response to exponential advances in computing power and connectivity. Most recently, new technology has raised the possibility of reduced reliance on centralized intermediaries like banks and credit card companies. In 2008, a person or group of people using the pseudonym Satoshi Nakamoto proposed a decentralized peer-to-peer system for making and processing payments. A key challenge in digital payments is to prevent the same assets from being spent twice. The Bitcoin white paper proposed a novel method for validating transactions using cryptography that addressed the so-called double spend problem. This and other innovations related to distributed ledger technology are the foundation for blockchain-based digital assets. Over time, the prices of Bitcoin and other cryptocurrencies have been quite volatile, and that's inhibited their widespread use in payments. Adoption of cryptocurrencies for payments may be further inhibited by high fees and slower processing times than those associated with other forms of payments. As a practical matter, you'd have a hard time using cryptocurrency to buy a sandwich or a gallon of milk. Other digital assets, like stablecoins or potential central bank digital currencies, could succeed at being more widely used as a medium of exchange, raising potential benefits and risks. Proponents believe distributed ledger technology will transform other aspects of financial services, like trading, borrowing, and lending. They point to capabilities like smart contracts, which use computer code to automatically execute an agreement if certain pre-specified conditions are met. To the extent that setup is more convenient and costs are competitive with those required for traditional financial services, digital assets offer the potential to expand access. President Biden's executive order tasked experts across the federal government with conducting in-depth analysis to balance the responsible development of digital assets with the risks they present. These tasks will be guided by 6 policy objectives. The first is to protect consumers, investors, and businesses. Second, safeguard financial stability from systemic risk. Third, mitigate national security risks. Fourth, promote U.S. leadership and economic competitiveness. Fifth, promote equitable access to safe and affordable financial services. And finally, support responsible technological advances which take account of important design considerations like those related to privacy, human rights, and climate change. Over approximately the next 6 months, Treasury will work with colleagues in the White House and other agencies to produce foundational reports related to these objectives. In many cases, the work tasked by the executive order builds upon ongoing efforts at Treasury. And I won't predict where this work will take us, but that doesn't mean that we are navigating without a compass. Digital assets may be new, but many of the issues they present are not new. We've enjoyed the benefits of innovation in the past, and we've also confronted some of the unintended consequences. So today, I want to share 5 lessons that apply as we navigate the opportunities and the challenges posed by these emerging technologies. These lessons relate to the nature of responsible innovation, the structure of appropriate guardrails, the fundamentals of the financial system, our role in the global economy, and the value of collaboration. Okay, the first lesson is that our financial system benefits from responsible innovation. New technologies build on older ones, and a chain of innovation has transformed financial services over time. 70 years ago, most Americans used coins, cash, and checks to manage most aspects of their financial lives. Then, in the 1960s, an engineer from IBM attached a magnetic strip to a plastic card and sparked a new category of payment products, credit and debit cards. Well, those innovations facilitated the growth of other technologies like ATMs, which make cash available 24/7. More recently, computers, the internet, and mobile phones have driven the explosive growth of electronic payments and online commerce. Although new technologies have made our financial system more efficient, For most Americans, many transactions still take too long to settle. A combination of technological factors and business incentives have produced a common frustrating experience that's shared by tens of millions of Americans every week. Their employer sends their paycheck, but it takes up to 2 days for the check to hit their bank account. That delay contributes to the use of high-cost check cashers or payday lenders to get their money in time to pay their bills. Some are forced to draw against already low balances, and they're charged overdraft fees. Estimates suggest Americans spend $15 billion or more each year on such fees and services. Essentially, that's a tax of about $100 per working American, due mostly to inefficiency, and it's disproportionately borne by people with lower incomes. The system is even more expensive and frustrating when you zoom out and look internationally. If you live in a G7 country, you may pay below 2% in transaction and conversion fees to send money across the border. If you live in the developing world, you may pay as high as 10%. And these costs disproportionately impact the 250 million plus migrants around the world who send an average of $200 to $300 in remittances to their families each month. So proponents of digital assets envision a more efficient payment system with instantaneous transactions and lower costs no matter where you live. Well, question, will the technology live up to that promise? Personally, I think it's too early to tell. Issues like processing time, cost, and technological barriers to access will need to be overcome. And the U.S. is actively involved in the work of the G20 to address challenges and frictions with cross-border funds transfers. And in 2023, the Federal Reserve currently plans to launch FedNow, which is an instant payment service that will enable payment in real time, around the clock, every day of the year within the U.S. payment system. Now, some have also suggested that the introduction of a central bank digital currency, or CBDC as it's known, could contribute to a more efficient payment system. As a liability of the central bank, a CBDC could become a form of trusted money, something comparable to physical cash, but potentially offering some of the projected benefits of digital assets. Under the executive order, the administration will publish a report on the future of money and payments. And the report will analyze possible design choices related to a potential CBDC and implications for payment systems, economic growth, financial stability, financial inclusion, and national security. Innovation that improves our lives while appropriately managing risks should be embraced. But we must also be mindful that financial innovation of the past too often has not benefited working families, and sometimes it's exacerbated inequality, given rise to illicit finance risks, and increased systemic financial risk. And that brings me to my next lesson. Lesson 2, when regulation fails to keep pace with innovation, vulnerable people often suffer the greatest harm. Look, this is a painful lesson we learned during the global financial crisis. Financial institutions called shadow banks and an explosion of new financial products allowed dangerous levels of risk to accumulate. Beginning in 2007, investors grew wary of these risks, and some large institutions began to falter. Soon, people who had never heard of a shadow bank or a subprime mortgage-backed security, they ended up losing their jobs and their life savings. The S&P fell by more than half. Household net worth dropped precipitously. The resulting economic distress was most acute and long-lasting for Black Americans and other Americans of color. And we need to ensure that the growth of digital assets does not allow similarly dangerous risks to emerge or lead to disproportionate impacts to vulnerable communities. Already, the Treasury has worked with the President's Working Group on Financial Markets, the FDIC, and the OCC, that's the controller of the currency, to study stablecoins, which are a type of cryptocurrency that's pegged to a stable source of value, often the US dollar. Stablecoins raise policy concerns, including those related to illicit finance, user protection, and systemic risk. And they're currently subject to inconsistent and fragmented oversight. To peg their stablecoin to $1, most issuers say that they back their coins with traditional assets that are safe and liquid. And this way, whenever you want to trade your stablecoin back into $1, the company says it has the money to make the exchange. But right now, no one can assure you that will happen. In times of stress, this type of uncertainty could lead to a run. And this is not hypothetical. A stablecoin run occurred in June 2021 when a sharp drop in the price of the assets used to back a stablecoin set off a negative feedback loop of stablecoin redemptions and further price declines. The President's Working Group report on stablecoins assesses these risks and proposes concrete solutions. And we're now working with Congress to advance legislation to help ensure that stablecoins are resilient to risks that could endanger consumers or the broader financial system. We're also working closely with our international partners to promote consistent regulation and supervision across jurisdictions. Of course, stablecoins are just one piece of a much larger ecosystem of digital assets. And our regulatory frameworks should be designed to support responsible innovation while managing risks, and especially those that could disrupt the financial system and the economy. As banks and other traditional financial firms become more involved in digital asset markets, regulatory frameworks will need to appropriately reflect the risks of these new activities. And new types of intermediaries, such as digital asset exchanges and other digital native intermediaries, these should be subject to appropriate forms of oversight. We also need to be prepared for possible changes in the structure of financial markets. For example, some have suggested that distributed ledger technology could reduce concentration in financial markets. While this could make markets less vulnerable to the failure of any particular firm, it's critical to ensure we maintain visibility into potential buildups of systemic risk and continue to have effective tools for tamping down excesses where they arise. President Biden's executive order calls on the Financial Stability Oversight Council to identify specific financial stability risks and regulatory gaps that are posed by various types of digital assets and to make recommendations to address them. And I say that I don't know what the FSOC will find at this point or conclude, but there is one basic lesson that should apply. That lesson is that regulation should be based on risks and activities and not on specific technologies. When new technologies enable new activities, products, and services, well, financial regulation needs to adjust. But that process should be guided by the risks associated with the services that are provided to households and businesses, and not based on the underlying technology. In other words, whenever possible, regulation should be tech neutral. For example, consumers, investors, and businesses should be protected from fraud and from misleading statements, regardless of whether assets are stored on a balance sheet or they're stored on a distributed ledger. Similarly, firms that hold customer assets, they should be required to ensure those assets aren't lost, stolen, or used without the customer's permission. And taxpayers should receive the same type of tax reporting on digital asset transactions that they receive on transactions in stocks and bonds. That way they'll have the information they need to report their income to the IRS. Under the executive order, we will work to make sure that consumers, investors, and businesses do have adequate protections from fraud and theft, privacy and data breaches, and unfair and abusive practices. Great care must also be applied to ensure that innovations don't cause disparate harm to vulnerable communities or exacerbate social, racial, or economic inequities. In many cases, regulators have authorities now they can use to promote these objectives, and Treasury supports those efforts. If people are breaking the law and exploiting the interests of others, well, they should be held accountable. To the extent there are gaps, we will make policy recommendations, including assessment of potential regulatory actions and legislative changes. Continuing to update and improve our regulatory architecture will support U.S. economic competitiveness and reinforce America's leadership in the global financial system. The principle of tech neutrality is also applicable to concerns related to tax evasion, illicit finance, and national security, topics that are particularly important in today's world. It's illegal to evade taxes, launder money, or avoid sanctions. And really, it doesn't matter whether you're using checks, wires, or cryptocurrency. For nearly a decade, Treasury has been monitoring innovations in digital assets, and we've been updating our rules and guidance to clarify the application of our anti-money laundering and countering the financing of terrorism framework to the digital asset system. We've also been working with our international counterparts to strengthen so-called AML-CFT programs abroad. That way, we can better protect against exploitation by illegal actors. And we'll continue to take action when appropriate. Just this week, in fact, Treasury's Office of Foreign Assets Control took strong action against the world's largest and most prominent darknet market, Hydra, as well as Garantex, which is a ransomware-enabling virtual currency exchange. Under the President's executive order, Treasury and colleagues across the administration will build upon a recently published national risk assessment, which identifies key illicit financing risks associated with digital assets. We'll also work with our allies and partners to help ensure international frameworks, capabilities, standards, and partnerships are aligned, and that they're adequately responsive to risks. Although innovations in computing have accelerated the pace of change, even the most foundational building blocks of our economy, including our money itself, have dramatically evolved over time. And that ties into my next lesson, which is that sovereign money is the core of a well-functioning financial system, and the United States benefits from the central role the dollar and U.S. financial institutions play in global finance. It took a long time for the United States to actually establish a uniform national currency. In 1790, Secretary Alexander Hamilton bemoaned what he called the immense disorder of the U.S. monetary system. At that time, Americans relied on a variety of domestic and international currencies which were circulating simultaneously. The proliferation of different forms of money really made it difficult to run the economy. So to help address these concerns, the Bank of the United States was formed in 1791, and it issued notes that provided a relatively stable national currency. In 1792, the Coinage Act was passed that created the U.S. Mint, and it kicked off a century of debate about whether the dollar should be pegged to silver or gold. Well, these important innovations helped standardize the backing of the dollar. The Bank of the United States did not have lasting political support, and by the mid-1800s, the country relied on a fragmented system of paper notes issued by private banks. Banks in New Jersey issued notes that were different from the ones that were issued in New Hampshire or New York. And because different banks were not seen to carry the same risks, people valued the notes differently. The system of private money, well, it functioned to a degree, but it made transactions expensive and inefficient, and it contributed to bank runs for many decades. So a crisis catalyzed reform. Embroiled in the Civil War, President Lincoln and Treasury Secretary Salmon Chase needed to introduce more stability to our financial system. So Congress passed the National Bank Act, and that allowed banks to issue national bank notes. But the banks had to be adequately supervised, and the notes were required to be backed with U.S. treasuries. That requirement ensured that a dollar in New Jersey was always as good as a dollar in New Hampshire. And later, the Federal Reserve Act further institutionalized the national objective of a uniform currency. The development of our currency to its current form, it's been a dynamic process, and it's one that took place over centuries. Today, monetary sovereignty and uniform currency, I believe, have brought clear benefits for economic growth and stability. Our approach to digital assets really needs to be guided by the appreciation of those benefits. Some have suggested that a central bank digital currency could be the next evolution in our currency. A recent report by the Federal Reserve, it opened a public dialogue about CBDCs and the potential benefits and risks that could be associated with issuing one in the U.S. The President's executive order calls for us to consider this question from several perspectives. For example, what impact would a U.S. CBDC have for implementing macro stabilization policies, and what implications for private credit creation? Could it make the financial system more equitable, accessible, and inclusive? How could it be designed to manage risks associated with national security and financial crime, at the same time including privacy protections? How might a U.S. CBDC interact with existing national currencies, with foreign CBDCs, or with private stablecoins? We need to consider these important questions in the context of the central role that the dollar plays in the world economy. The dollar is the most widely used currency for global trade and finance, and it is by far the most traded currency, accounting for nearly 90% of one leg in foreign exchange transactions and over half of trading invoices. U.S. dollar-denominated assets account for about half of cross-border bank claims and more than 40% of outstanding international debt securities. And with the dollar's strong trade and financial linkages, as well as strong U.S. macroeconomic and monetary credibility, central banks have chosen to hold nearly 60% of their foreign reserves in dollars. The dollar's international prominence is strongly supported by U.S. institutions and policies, by U.S. economic performance, by our open, deep, and liquid financial markets, by the rule of law, and by a commitment to a free-floating currency. As citizens of this country, we derive significant economic and national security benefits from the unique role the dollar and U.S. financial institutions play in the global financial system. So the President's executive order asks us to consider whether and how the issuance of a public CBDC would support this role. I can't tell you yet the conclusions we will reach, but we must be clear that issuing a CBDC would likely present a major design and engineering challenge that would require years of development, not months. And for that reason, I share the President's urgency in pulling forward research to understand the challenges and opportunities a CBDC could present to American interests. As we consider these big choices, we also have to remember that technology-driven financial innovation, that's something that's inherently cross-border and it requires international cooperation. And we have a strong interest in ensuring that innovation doesn't lead to a fragmentation in international payment architectures, and that the development of digital asset technologies is consistent with our values and laws. And this underscores my final lesson, which is we need to work together to ensure responsible innovation. Many of the most groundbreaking innovations in our history have involved all of us, policymakers and business people, advocates, scholars, inventors, and citizens. Think of the development of the national highway system, the space race, the creation of the internet, or the ongoing revolution in biotechnology. All of these innovations have transformed the way we live our lives. And people have a wide range of views when it comes to digital assets. On the one hand, some proponents speak as if the technology is so radically and beneficially transformative that the government should just step back completely and let innovation take its course. On the other hand, there are skeptics that see limited, if any, value in this technology and associated products, and they advocate that the government take a much more restrictive approach. Such a divergence of perspectives has often been associated with new and transformative technologies. So, in my view, the government's role should be to ensure responsible innovation, innovation that works for all Americans, that protects our national security interests and our planet, that contributes to our economic competitiveness and growth. Such responsible innovation should reflect thoughtful public-private dialogue and take account of the many lessons we've learned throughout our financial history. I think this sort of pragmatism has served us well in the past, and I think that's the right approach today. So let me stop there. I want to thank you again for having me, and thanks for the important role American University plays in the civic and academic life of our country. Thank you all for listening to these remarks. Thank you.
Thank you for joining us. This concludes our programming.